Good morning, everybody. Welcome to the Seiler Wealth Management video blog. Today is Tuesday, May 3rd, and last week stocks got beat up a little bit, and mostly were the big cap tech names. Those are the giant ones, the Microsofts of the world, the Netflix of the world, the Apples of the world. Those stocks came in with earnings that disappoint Wall Street, and that's what happens. And on the other hand, you had Facebook, who beat earnings and did pretty well. Amazon beat earnings, and their stock price did pretty well. But all in all, in general, the Dow, the S&P 500 were down 1.3%, while the NASDAQ, which is big cap tech names, they were down over 2%. Now, for the year, we're not doing great. All right, the NASDAQ is down for the year, down about 4%. The major averages are down up barely, about 1% or so. So, if you don't have certain segments of the market in your portfolio, you're not making money. You're probably flat to down. And that's okay, because not everybody knows these segments are working. But let me just tell you what has been working. And the reason I know this is because we own these segments in our portfolios. We own a lot of energy. All right, energy didn't do great last year, but guess what? It's doing incredible this year. Gold has been doing really well this year. Now, I don't own gold. However, I do own energy, so that's been doing great. Healthcare has got a little bit frisky, so it's kind of bumping up. You had good earnings out of J&J, but I want to take a step back and talk to you about earnings, which, for the most part, are down year over year. Now, of course, some people say, well, if you take out the energy stocks, but you know what? You can't. You can't just pick and choose what you want. The market is the market, okay? So earnings are down year over year, probably end up going to be down 7% from last year. And yes, if you pulled out the energy stocks that are down 30 and 40%, okay, that would make a difference. But let me tell you what has helped corporate earnings. And call it artificial, call it whatever you want. But when companies make a ton of money, they have options with that money. For example, Apple has $200 billion in cash overseas. Hopefully, when somebody changes the tax law, the next president will be able to get that money back into this country and create some jobs, okay? So you have all this cash. A couple things you could do. You could hold on to it, which gets you nothing. You can reinvest it in R&D, which most of these companies do. You can buy other companies for their technologies or research and development. That's great. You can give back to your shareholders in the form of a dividend, which is also very good. And in fact, back in the 1920s, when people first started investing in the stock markets, you bought a stock for the dividend. Company did well, they gave back to the shareholders. You weren't so concerned about stock price, but now it's dividend. And one of the other options is the company can buy back stock. So how does that affect you as a shareholder? Well, let's just make it simple. Let's say XYZ company has 1,000 shares outstanding, and they made $1 per share, which means they made $1,000. That's their profit. So you take the way you figure out earnings per share, you have 1,000 shares. They made $1,000, so 1,000 shares until $1,000 is $1 per share. Makes it simple than saying, hey, Johnson & Johnson made $52,400,000,600. We don't want to do that. J&J made $7.46 a share. So you have 1,000 shares, you made $1,000, $1 a share in earnings per share. So let's say you have that same earnings, but then XYZ company decided, I want to buy back 500 shares. I want to take 500 shares of that 1,000 off the market. Now all of a sudden your earnings per share is $2 a share. And that's how a lot of companies are increasing their earnings right now, is through corporate buybacks. Now, it's not a bad thing, okay? They're just not growing organically. They're growing through processes, through plans that they have. And you know what? The good news is, if the company is buying back stock, they believe their stock price is going to be worth more. So that's a good sign. If they're saying, you know what? Now, oftentimes, companies may announce, hey, we're going to buy $5 billion back of our stock. Okay, let's see you do it. Because what that tells me, especially a couple things about buybacks. If companies buy back their stock when stock's at a high, great sign. They have the confidence that when that stock is way up here at a high and they're buying it back, terrific sign. If the company is buying back when the stock's at a low, also a good sign, because they have confidence saying, hey, I think we've hit a bottom. Let's buy back all this stock. Because remember, stock price goes up, they own that stock, they're going to make money there too. That puts their shareholders' cash to work for them. So yes, Some buybacks are garbage. They announce it, they don't do it. They say, oh yeah, we're going to buy it over the next 20 years. Okay, whatever. But corporate buybacks are not a bad thing. But yes, do they artificially bring down earnings or make earnings look better than they are? Sure, but that's always been like that. And corporate buybacks, I think, are actually a pretty good thing. Sure, would I like to see more dividends? Apple, with their war chest of cash, decide they're going to pay more in the form of a dividend. That's great, but they're always buying back stock. Now, let's talk about Apple. And right now, everybody's down on Apple. Well, this happens. It happens periodically. Look, the stock's been a great stock for years and years and years. I own it. We own it in the 40s, okay? So I'm not that concerned. I think down here is probably a value. I'm not telling you to buy it. I'm not telling you to sell it. I'm telling you that we haven't sold a share because they are going to come out with a new product September. And if the iPhone 7 comes out or other products, the stock will rally back up. Not to mention, it is the cheapest stock in the market for the most part. Okay, I'm not absolute cheapest, but it's so cheap, and it's so cheaper than the S&P 500. So if anybody out there, and I heard price targets yesterday go up to 160. They're still like in the stock. I'm not sure it goes to 160, but I think Apple could probably at some point go back up to 120, 130. I mean, that's realistic. We have another quarter of turnarounds. Because they're just trading very, very cheap relative to the market. So before you go out and do something like buy an Apple, consult with me. Certainly, I'd be glad to see if it fits in your portfolio. Make sure you can assume risk. Although it's a cheap stock, it could get a whole heck of a lot cheaper. All right. Same thing with the Netflix of the world. So Netflix is not a cheap stock, but it's a momentum stock, which really has no momentum right now. I do continue to believe energy is going to do well. Banks have basically stuck right now because the Fed didn't raise rates. They're going to raise rates in June. They'll start seeing money flow back into the bank. So don't be discouraged on them. Go ahead and just continue to own them and invest dollar cost average in those banks. I like them a lot right now, and I think they're going to be a huge move 12 months from now. And think of your plan as long term. Don't worry about the short term gyrations. I would let us worry about it. Let the money managers worry about it, because somebody comes in today with fresh cash, say, hey, I have $500,000. I can't invest all the money today because I'm not that confident in the market. I do believe the market's going to pull back. We're indicating 100 and change on the pullback. We were up yesterday. You have the old adage, sell in May and go away. It didn't work last year. It's all noise. Let the stocks, let the investments tell me whether I need to sell them. That's what I'm going to try and do. And that's why we use certain stop areas and certain protection methods. So we do take appointments, and we have been taking appointments. Thank you very much. And, I have a few cruises left. I'm trying to get more because they've gone. But I encourage you to share my video. It's great information. Also, on my website, there's a ton. Anything you want to know about, whether it's your company retirement plan, it's in there. Also, there's all kinds of great downloads and white papers on my Facebook, all safe to download. So check it out. There's college funds. There's all kinds of things we can talk about. And thank you for all your questions, and thanks for coming in and becoming clients. A lot of you guys, it's amazing that Facebook, it does work for us. We do get clients out of it, and we only want the clients that we want to work with. So we don't take everybody. We realize that, and some people we do turn away. But if we like you and we think it's a good fit, yes, we'll take you on as a client. In the meantime, you guys have a great day, and this is a very difficult week. Not sure I'm going to do a report on Thursday. My daughter, my baby, my last one will be graduating college on Friday from UCF. Thank you very much. I just got a raise in my household, so both my kids done. College graduations done. Anyway, so graduation's Friday. Am I going to do this on Thursday? I don't know, but I may. Anyway, you guys have a great day. I know I'm going to have a great week. This is Lee Seiler, also known as the Stock Doctor. Check out the website, stockdr.com. That's stockdr.com or seilerwealth.com. 2 names, 1 site, great info. I'll talk to you soon.